Namaste and Salam Alaikum, distinguished members and guests. It is my pleasure to welcome you all to today's webinar, an important one on India's budget 2021, economic prospects and growth roadmap. Today, to take this forward on such an important topic, we have a distinguished and eminent panel comprising of Dr. Soumya Kanti Ghosh, Chief Economist of SBI, Shri C. Venkat Nageswar. We also have with us Mr. BRS Satyanarayan, CGM SBI, plus Mr. V. Raghavan, the General Manager, the Resident General Manager in Dubai of SBI. Today's topic is definitely important, but today evening, we also have a lot of guests who have joined from elsewhere. So for the guests, IBPC Dubai is a premier Indian Business Council, Indian Business and Professional Council in Dubai under the auspices of Dubai Chamber of Commerce and Industry. And it serves as a platform to further UAE-India business relationship, as well as a networking platform for professional and businessmen. And anyone wants to join, I would recommend you people to go on ibpcdubai.com and have a look. Without much ado, I would like to invite our distinguished chairman of IBPC, Mr. Suresh Kumar, to give his keynote address for this evening session and take this evening session forward. Namaste and good evening.
Dear members, good evening. Greetings to all of you and your families. I trust you're all keeping well and safe. It's also an important day in the UAE. Yesterday, we had the Mars probe to the planet of Mars, and UAE joined the distinguished 5-member nations league that accomplished this significant space move. So it's a happy day in that sense, and we're particularly pleased that today we have a distinguished delegation from SBI, the State Bank of India, India's premier institution in the world of banking and finance, joining us. I'm sure it will be a stimulating discussion as we look at, or as we review the outlook for India, the economic outlook, and the growth opportunities in the context of the recent budget and post-budget key developments as they have been announced. The budget itself has been a path-breaking budget. It's possibly the first budget that has made the rightful and very significant, very large investment focused in terms of capital expenditure, in terms of infrastructure expenditure, particularly healthcare expenditure, given the COVID implications. And SBI has played a pivotal role in how the Indian economy has moved forward. As India's largest bank, and now following the merger of its subsidiaries, one of the top 50 banks in the world, SBI has clearly been the bank to watch for in terms of policy moves, in terms of the progress that they have accomplished over the years. There always sends very good signals about the Indian economy. So in a sense, like the stock exchange, SBI is a mirror to the Indian economy, one of the mirrors that reflect how well and how focused the economy can be and should be and is. So I wouldn't want to steal the thunder, but I would like Sibi to quickly introduce our members by way of a slide. So without further ado, let me invite Mr. Venkat Nageswar to lead the discussions this evening with his comments. Over to you.
Thank you, Mr. Suresh. Respected Mr. Suresh Kumar, ladies and gentlemen, good evening to all of you. It's wonderful to have you all in this important virtual seminar to decipher and dissect the Union Budget 2021-22. I thank IBPC Dubai for inviting me to this event. The outbreak of COVID-19 in China in January and its rapid spread across the globe has created unprecedented economic crisis. We are now in the 14th month since the outbreak was declared pandemic by the World Health Organization. The pandemic continues to keep the world on the edge with uncertainty about flattening of the COVID curve due to various mutations of the virus, like UK strain and South African strain. The world has stepped into 2021 in the hope for the future. There was immense speculation as to whether or to what letter of alphabet the shape of the post-COVID economy be. A wide range have been predicted. You talk about U-shaped, you talk about W-shaped, you talk about V-shaped, and some did talk about K-shaped also. With vaccination now starting and segments of economy showing resilience, there are good prospects of economic recovery from the year 2021. In India, the Reserve Bank of India had stepped forward and has announced various liquidity, monetary, regulatory, and supervisory measures in the form of interest rate cuts, high structural and durable liquidity, moratorium on debt servicing, asset classification standstill, and recently stressed special resolution window within our prudential framework for resolution of stressed assets. The outlook of growth in Indian economy has improved significantly with the positive growth impulses becoming more broad-based and rollout of vaccination program, as I said earlier, in the country is auguring well for the end in the pandemic. One of the important things that is the inflation, which was a bit worrisome earlier, has returned within the tolerance band. RBI has kept it tolerance band of 4% plus or minus 2%. Now it has come within this tolerance band. And the RBI feels that the need of the hour is to continue to support growth as well as the impact of COVID-19 and return the economy to a higher growth trajectory. RBI's survey points towards the improvement in capacity utilization in the manufacturing sector to 63.3% in Q2 from 43.7% during the preceding year. The consumer confidence is also reviving and business expectations of manufacturing, services, and infrastructure remain upbeat. The movement of goods and people and domestic trading activity are growing at a robust pace now. In this backdrop, the Honorable Finance Minister had presented the Budget 2021-22, which is based on the 6 key pillars: health and well-being, physical and financial capital infrastructure, inclusive development, development of human capital, innovation and research and development, minimum government, and maximum governance. I know Soumya Kanti is going to, as I said in the beginning, is going to dissect it, but I just want to summarize that this is a very bold budget because it is a budget for growth. If you look at the capital expenditure, it's shown that it is going to be around 5.5 lakh crores. It is a budget for transparency. It is for the first time that extra budgeted borrowings are brought into the on board. And also they have removed the overt reliance of FCI on NSSF. It's a budget for health, focusing on 3 areas: preventive, creative, and well-being. It's a budget for stability with cleaning up of the balance sheets of the banks. They are creating a bad bank and a ARC, AMC, AIF structure. And also there's a huge disinvestment program. It's a very, very bold budget, as I said earlier. India's banking and financial system has displayed tremendous operational resilience in the face of COVID and lockdowns, As Mr. Suresh has rightly pointed out, SBI was serving all our customers throughout the globe, and not a single day had passed where we have not served our customers. So, and going ahead, the financial institutions of India have to walk a tightrope of nurturing the recovery within the overreaching objective of preserving the long-term stability of the financial system. State Bank of India, which is the bellwether for the Indian economy, in its latest and Q3 results, had beaten the analyst expectations and showed to the market that the worst may be over. Asset quality has improved sequentially, even after accounting for a standstill bad loan recovery by the Supreme Court. We have reported an operating profit which is very robust in a challenging environment. Loan growth is showing healthy recovery in the retail portfolio, with disbursement in many business segments surpassing the pre-COVID levels. The deposit growth stood strong while margin remains broadly stable. And in fact, the markets have given thumbs up to SBI results and improved the shares price substantially. The Indian rupee, which is on an appreciating spree, with FII flows touching almost $3.1 billion in the calendar year, reposing faith in recovery of the Indian economy. Instantly, as I said earlier, the RBI has taken various measures. In the recent policy also, they have kept the policy rate steady with an accommodative stance. They see 10.5% GDP growth in financial year 2022. While I started off my delivery speech saying that world is expecting that the economy to recover either in U, V, W or K shape, but with all the measures that are being taken both by the regulators and the government, I am very confident and I have no doubt in my mind that we will see a V-shaped recovery in the Indian economy and propel this economy to a greater heights after this tumultuous year in 2020. With these few words, I leave the floor to Dr. Ghosh to simplify and present the budget before this August audience. Thank you, stay safe, stay well, and namaskar.
Good evening, everybody. Venkat sir, thank you very much for setting the tone for the evening, taking a holistic view and also for the very positive outlook that you have. Thank you very much. And we now welcome Dr. Soumya Ghosh, Group Chief Economic Advisor of State Bank of India. In fact, I think the slides that CB and his team had put up already have told us about the background of Mr. Soumya Ghosh. For us, of course, for us state bankers and others, we don't need to be told about him. We have been seeing him for so many years now. But for the audience, that was a very good slide put up. I now request Dr. Soumya Ghosh to enlighten us with the views on the budget. Thank you.
Thank you, everyone. And I will shortly share the screen. And thank you, IBPC, and thank you, everyone, for a nice introduction. Thank you for DMD sir and also the host for taking all the pain. But it's a pain worth taking because as the budget has said, without any short-term pain, there is no long-term gain. So I think that this budget which has been announced is equivalent of the 1991 budget, if not more. So, and as you will see in the course of the next half an hour or maybe 40 minutes or whatever, I mean, as we continue to chug along, I think this is one of the best budget in terms of its content, in terms of its delivery. And the only thing which is left for is execution, which hopefully will be done. And as I share the screen right now, yeah. Yes, okay. So as we present over here today, only morning we released a report. So we have actually revised our GDP forecast today. So our model is now showing that the GDP growth will be positive in both the third and the fourth quarter. And our forecast is actually now a contraction of 7%, and the CSO cost contraction is of 7.7%. So basically, we had seen a significant amount of economic recovery in the last 3 to 4 months. And I will take you through some of the important initiatives which the budget has done, and also a brief description of the Indian economy of why you are so hopeful about its growth prospects. The first thing I'll start with is very quickly the SBI Q3 results, which actually has been fascinating. And it's not only, I mean, why I would like to say about this is that SBI is a parameter of the economy, and the most important thing is that all the numbers are actually showing very healthy growth. And the most important outcome is that the restructuring application are as minuscule levels. And in fact, these minuscule levels that actually, if you remember when the pandemic started, there was an avalanche of writings and ideas that Indian banking sector again will reach the levels of asset quality, bad levels asset quality as it was in the early 2000s, but nothing of that sort is going to happen. In fact, the banking sector will be a witness to the most positive outcome in this fiscal year. And as I will show, the MCARC will be is a very positive outcome which has been introduced in the budget. Incidentally, this has been one of our bank suggestions. And in fact, this is the BMD was one of the proponents of this report. So we know what is the structure could actually do to the banking system. The banking sector now has a provision coverage ratio of more than 90%. So everything we have covered now. There has been more digital customer has been onboarding. We have, if you remember, in July of 2020, when the COVID was at its peak, the entire banking system had the maximum number of retail loan disbursements. So basically, all of these were almost done digitally. And the important point is that the bank is significantly, extremely well capitalized. These are some of the numbers. I'll not take into it because this is all on the slides. But the important thing is that the CD ratio is at low level. So there is ample level to grow from this current. There is significant liquidity available. The RBI has made liquidity available on an extended surplus mode, at least for this fiscal year, to support the significant borrowing program. So these all numbers show that the bank is extremely well poised, and the Indian economy Indian economy is also well poised for a significant amount of growth. Let me now take into some of the global economy. As you can see that the global gross domestic product had declined by an estimated 4 to 4.3% in 2020. I think this was a surface contraction of global output since the depression. But the important point is that the global economy is projected to grow 5.5% in 2021, which is one of the fastest growth rates, much higher than what happened after the depression, and 4.2% in 2022. But there are, of course, some signs of worries. There could be increase in inequality because there could be some amount of increase in poverty. But even if I take into that, there's also the fact that the COVID-19 could deliver a significant shock to the global trade. Tourist arrivals could actually decline. And that has been one of the most important things where the service sector growth rate will continue to be on the lower side, because these are contact tracing sectors. Global trades and goods services could decline by close to 8% in 20, but the important point is that 2021 and 2022 forecasts are very healthy and there could be an upside. But another thing is that the digitalization in transforming manufacturing and services delivery worldwide, and India is actually not an exception to this. In fact, India is an outlier in the digitization of, at least if I look into the banking services, what has been happening. So this is the most important point and the positives we have to take about from the global growth outlook. Now, what are the other things? India is the 5th largest economy. IMF projects a growth rate of 11.5%, but I can tell you that this number could be on the lower side, because the budget has estimated a nominal GDP growth rate number of 14.4%. So which we believe is on the lower side. So basically, if this nominal GDP growth rate is on the higher side, then the government could even spend much larger amount than what is anticipated. India has crossed the 70 billion mark in FDI inflows. As you all know, it's a significant youth population. The national infrastructure pipeline will attract investment to infrastructure. We had a goal of becoming a 5 trillion economy by 2025. Yeah, but my sense is that that's just a number. So we can always be delayed by 1 year or 2 years, but that's just a number. That's an ambition. We just wanted to put it the number over here. 42% of the Indian population to urbanize from 31% in 2011. India has jumped 79 positions in World Bank Ease of Doing Business ranking and 48 in the Global Innovation Index. And India's current account will be in surplus for the first time in 18 years. So that is going to be a record achievement on the part of India. Now, this is some of the things which I talked about over there. India's industrial corridors, if you just look into it, is actually runs throughout the country. Delhi, Mumbai, Bengaluru, Mumbai, Vizag, Chennai, Bengaluru, Amritsar, Kolkata. Remember in 2002, early 2000, when the earlier India government was in power, the golden quadrilateral was actually was launched, and that was one of the reasons why the India had the golden years of growth beginning the golden years of growth from 2004 onwards till 2008. The other important thing is that the GDP growth, as I just said, has now significantly improved. That's why we are now forecasting a positive growth in third quarter, which is going to be a remarkable achievement from a contraction of -24% in the first quarter. And this is some of the numbers which is important. The red line, for example, is the SBI Business Activity Index. This Business Activity Index we have constructed based on the electricity generation, the UA bills and other things. And it is indexed to 100 in February 2020. So this is now at 98.2, implying that we are almost at the level of pre-COVID level. This number actually had crossed 100 last week, but it has come down to 98. That means that it is almost we're at the pre-COVID level. All indicators, we had a record GST revenue in the month of January, the record since the GST was launched in 2017. The total nominal loss of GDP growth in first quarter will be 180. The CSO says the nominal positive growth in second quarter could be US 62 billion, but we expect this number could actually go up because our numbers are now 7% contraction instead of the 7.7% contraction by the CSO. So electricity demand, transactions, cargo traffic, tractor sales, everything is now at over pre-COVID level. And as I said, our business activity index is almost at the pre-COVID level, and it actually had crossed the pre-COVID level in the last weeks. Now it is 98.2, and all leading accelerations, percentage of indicators showing acceleration is now 78% of all the I think 45 leading indicators which we track on a monthly basis. So basically it means that the economy has recovered significantly from what it was earlier. This is basically the important point, that the inflation numbers as you can see, were higher from December onwards. As you know, India is an inflation targeting country with an inflation between 2 to 6%. But inflation was higher. But the good thing is that the inflation has started to decline from November. December inflation number was at around 4.5%, and on Friday, we are expecting the January inflation number will be out, and our estimates are that this inflation number could actually fall to close to 4%. So basically, the inflation is now within reasonable limits. Of course, there will be some. There will be some numbers of inflation which could be a little bit up and down, but as of now, it is declining. The IIP growth has turned positive after a 60% decline in April 2020. The UA bills, which had declined by 150% in April 2020, is now increasing by 10% on a year-on-year basis. So we can look into the amount of recovery which we have done from April 2020 till date. So minus 150% to plus 10%, minus 60% to around 2%, which we had a growth in October. So this is so basically the recovery has been very strong and great. I will not say it even great. The recovery has been actually very strong. India's current account will be bad in the first quarter surplus after a period of 18 years. India is one of the countries where the equity inflows from FIIs into India has been positive. As you can see, all other countries has been negative, but India has witnessed a 25 billion US FII equity inflows from the FIIs. Indian external debt is comfortable. The ratio of short-term debt to total reserves has been declining. India is now the 5th largest country I think not fifth, the fourth largest country in the world in terms of foreign exchange reserves. We are close to 600 billion foreign exchange reserves. Our accretion in foreign exchange reserves in the current fiscal is now around 115 billion, or it is the highest level. It's higher than 2008 when we had a foreign exchange accretion of 110 billion. So I think we have now 120 billion foreign exchange accretion in the current year, which is a record. So, and the next set, so basically external sector is comfortable. Next, if you look into this slide, this is the composition of exports. The inner cycle shows the composition of exports from April to November 2019, and the outer cycle shows the composition of exports in the current year. The interesting thing is that our petroleum products consumption have actually declined, but the important point is that our drugs formulation exports have actually increased. That's why today the government is saying that India could actually become the pharmacy of the world. And there are also several in the input part. What we have done consciously is that we are cutting down on the electronic components imports, primarily from China. The important point is that the Reserve Bank of India is also following an exchange rate strategy when the rupee has appreciated against the US dollar. But in fact, it has depreciated against the Chinese yuan, indicating that there could be a conscious effort on the part of the India in terms of its Atmanirbhar Bharat initiative to build up its domestic capabilities. And I think there has been a lot of talk about this Atmanirbhar Bharat. Let me tell you one point over here is that in 2008, when the global economy was going through the financial crisis, if you remember, the US actually built up its shale production, and today they have actually reached a situation of strength. China also in the same point of time had actually looked inward in terms of building up its domestic manufacturing capability from the lower end. And today China has actually vacated the lower end of the domestic manufacturing the cycle. And India is actually doing the same thing today, trying to build up on its manufacturing capability in a bigger way. So Atmanirbhar Bharat doesn't mean you are looking inward. It is just trying to take advantage of the current pandemic. And there has been examples of other countries like US and China, what they did in 2008 to take advantage of a crisis. So I think this is a well thought out strategy which will complement India's domestic the manufacturing sector and also increase the competitiveness of the India's manufacturing sector. I will give you the numbers of the schemes which the government has introduced. Then this is basically the most important thing, that there has been an increase in the financial savings in Q1. The household financial savings has jumped to 21.4% in Q1. And our next, indicates the numbers of that are officially not available, but our estimates suggest that this number could be higher than 21.4%. This is a significant. India has a GDP, as you know, of around 200 lakh crores. So 21% of this, 20% of this number is actually 40 lakh crores. So this is extremely important that and since India is actually setting up its infrastructure program, India has an infrastructure program for around 111 lakh crores over the next 5 years. So it is important that the household savings actually contributes to that. The reasons for this increase in household savings, however, was different because people are unable to spend and people are building up precautionary savings. But whatever as the reasons, as a default, the household savings has increased. And that is also one of the reasons why the financial markets have been so buoyant. I will come to all that discussion at a later point of time. Now, this is the other important thing. And this is one of the reasons why the Indian economy improved so dramatically in the second quarter. I'll just spend some time over here. And with this, basically, this is the data which I'm showing of the trade, hotels, trade, transport, and communication segment. There's a subsector in the service sector. What happened is that during the pandemic, before the pandemic, as you know, India has witnessed a strict lockdown. The Indian economy was locked down for a period of 3 months, which actually paid us rich dividends. I will show you in a subsequent slides. But after the economy was opened up, there was significant movement of commodities across the state borders. So basically that explains why the trade and the transport sector did so well. There was transportation, the freight traffic, the port traffic all went up well. The communication segment also went up well because people are sitting at home using data. So the communication, the wireless data uses per subscribers went up well. The mobile subscribers, we lost 2 crore mobile subscribers, but we have subsequently gained all of them, if not more, in the subsequent months. So all these data actually are a part of the trade, hotels, transport and communications, trade, transport and communications segment. And that was one of the segments, service segment, which did remarkably well in the second quarter and contributed to the much lower GDP contraction as the market was anticipating. And as you can see over here, the data contribution has increased, and the data consumption in India is supposed to increase to 25 GB per month by 2025. And this is one of the most significant opportunities which you could have in this telecom segment. Some next slide is that how did India manage COVID-19? Because that's one point which I want to show. As all of us know, India had reached the COVID peak of 16 September. After that, the cases have been declining. Yesterday's results show that there was no deaths for the first time after a significant time. And we actually did an econometric exercise. I'll not get into the details of that. Basically, that was an exercise whereby the important point is that we took population as one of the control variables, because everybody says that India is a large country, so it's adjust for population. So if we adjust for population, and our model shows that till 28th January, India has lowered the infections by at least 34 lakhs, which is 3.4 million. The economic survey shows that it is around 37 lakhs. We can debate whether it is 34 lakhs or 37 lakhs. But the important point is that India has managed COVID remarkably well, and that is one of the reasons why India has been able to come out of the slumber much quickly than what it was earlier anticipated. The second position is that this is the data which is so remarkable, that India's position vis-a-vis other countries. If you look into India's positions, US, for example, has number of cases higher than India. Again, it is based on a model estimates. US number of cases are 100 lakh cases more than India. Mexico, Italy, France, Indonesia, any countries you see, the number of cases is much higher than India. And it has come even after these countries as a health expenditure, which is significantly higher than India, and hospital beds per 1,000, which is significantly higher than India. So it is clearly visible that India's people has shown resilience, India's economy has shown resilience, and the Indian government has also has been able to control the disease to a significant extent. Let me talk on a lighter note today, saying that perhaps we have developed an antibody much earlier. Before the vaccine, we have been vaccinated. And there is some data in public domain. I'll give you some numbers. For example, in 2018, the total number of pneumonia cases in India was around 4 crore, which is 40 million. But do you know the number of deaths? It was around 3,078. So basically, India as a country and all these, and the last slide, what I showed you, as basically the important point is that you can see that the states which has a bad health infrastructure, for example, Uttar Pradesh, Bihar, they have done remarkably well. Uttar Pradesh is of the size of Brazil. It reduces cases by 11 lakhs. Bihar reduces cases by 7.2 lakhs. And there are some states which may not have done that well, but overall India has done quite well in terms of controlling the disease, and that states which are bad in health infrastructure has perhaps done well, indicating the resilience of the Indian population. And also, whatever people might say, I think also the discipline of the Indian population in terms of using their mask and other things. So I think this is one thing which I want to highlight again and again, because that has been the remarkable differentiator of India being able to stop pandemic in its source. Now, India's vaccination drive started on 16, but already it is going at an exponential pace. More than 100 million people has been vaccinated, out of which 4 million are from India. This figure may be a dated one, but this 4 million is got up higher. But the important point is that India's curve is rising exponentially. It is now higher than the speed of vaccination of the world. So this is another thing, that India's speed of vaccination is very impressive. Now, let me come into the budget numbers. What are the budget arithmetic? The important point is that in FY22, the government has projected the capital expenditure in real terms. Please note it is in real terms of around 21%, while the revenue expenditure growth is supposed to decline. So basically, and revenue receipts are also projected at more than 10% in real terms. Let me tell you something about the capital expenditure. If I look into in terms of the Indian currency, in FY22, the total expenditure is supposed to increase by only around, say, 330 billion, which is 33,000 crores. But the capital expenditure is supposed to increase by 1.15 lakh crores, and the revenue expenditure is supposed to decline by around 80,000 crores. So that makes a figure of around 330 billion. But this 1.15 lakh crores increase in capital expenditure is 4.7 times the average increase of 225,000 crore over a period of 2 decades. So basically, the capital expenditure focus has been significant in the current budget, and that's the most important thing in terms of growth. The genesis of fiscal deficit in incremental terms is that what was the problem in FY21? We had a revenue loss of 120 billion, expenditure increase of 56 billion. So the fiscal deficit actually increased by 109 billion to US 253 billion. But the important point is that 75% of this increase in expenditure was because of the food subsidy. So this actually explains the human nature of our controlling the pandemic. We have not allowed anyone to go hungry in India even during this pandemic, and that is the reason why there was such a massive jump in food subsidy during this particular fiscal. And this is actually an extremely creditable achievement, because today we are providing foods free of people to around 70 to 75 crores population in the country, which is unheard of any country, even if a country which is running such a large food subsidy program. This is the budget numbers. What are the numbers which actually holds the key? The non-tax revenue which holds the key. The other risk is basically the disinvestment risk also holds the key. As you know that last year we missed the disinvestment risk of Air India, also LIC. But this time I think the government has done its homework very well, and I am hopeful that possibly this disinvestment target could be exceeded if the government goes in a methodical fashion. The fiscal deficit is at 9.5%. It will be brought down to 6.8%. But let me take you some positives about the fiscal deficit today. The important point is that corporate tax and income tax will recover next year to grow at 24% each. But these numbers, it has to be taken against the fact is that there was a 22% decline last year. So it is coming over the top of that. And I think these numbers are actually very, very conservative. Why conservative? Look into this one. This is basically gives you a record of the Indian tax buoyancy over the last 2 decades. Basically, tax buoyancy indicates how much the growth in gross tax revenue will happen because of a growth in nominal GDP. The interesting point is that in FY22 tax buoyancy, we are estimating it lower than FY21. So basically, FY21 means this current fiscal. So basically, I mean, the budget is under promising and it is going to deliver more. So under promising and over delivering. We can't have an tax buoyancy which is lower than this pandemic year, which was an unprecedented year. So if this is the case, I think the tax numbers are extremely conservative, and this 9.5% also, this number, which I will come to this 9.5% later. But the important point is that the disinvestment target, if I look into this, is 25 billion disinvestment target on the base of LIC IPO. As you know, India had a mixed record of disinvestment, but the important point is that it has missed the budget estimates of disinvestment for some periods of time, and there has been obviously questions on that. But let me give you a spin over here. In FY18 and FY19, we had actually surpassed the budget estimates of disinvestment. In FY20, we could not make it, as all of us knows, because of the pandemic. And in FY21 also, and FY20 also, there was a general slowdown. But the FY21, we missed it. But in FY22, I think given the current market buoyancy, the market conditions, we are sure to make it in terms of the disinvestment numbers, because there are 2 institutions, 2 public sector banks and 1 general insurance company which the government wants to disinvestment as a test case. So that is also will increase the valuation of the financial sector to a significant extent, as we are seeing right now. Now, the important point is that subsidy bill in FY21 had increased by a significant amount, because both food and fertilizer the subsidy has jumped significantly, as we wanted to front load the expenditure to feed the poor and feed the farmers. And food subsidy bill is actually inflated by 1.7 billion, because what has happened this time is that the government has actually significantly brought the off-balance sheet financing of the FCI through NSSF to the headline deficit. In fact, the fiscal deficit of 9.5%, if we exclude the off-balance sheet liabilities of the government, this is coming at 8.7%. And next year also, the government hopes to bring a large amount of off-balance sheet subsidy to the headline. So therefore, by 2020, so this basically this fiscal deficit gives you a true extent of the fiscal indebtedness of the country, and that's why it is. And this transparency, we actually are calling it a CSR budget, basically a consolidation budget, because we are bringing the off-balance sheet into the headline inflation number, a spending budget. So that is our, and the recovery budget, because it is also taking several steps to recover the economy. So this is important point you need to know, is that the subsidy numbers over here could be inflated, and the government has actually completely reduced the petroleum subsidy. The food subsidies also was inflated this year, but next year it will come down to normal levels as we clean up the FCI balance sheet. Now, this is basically what I talked just now. The government has shifted around 22 billion from the off-balance sheet to food subsidy in FY21. If we actually take out the off-balance sheet, the fiscal deficit is 8.7%. But the important point is that even if I take out the off-balance sheet, the expenditure which are brought down to the mainstream, even then the total food subsidy, even the actual incremental spending is still 1.3% of GDP in the current fiscal, which is US 35 billion. And this is the direct fiscal impulse which the government has done to rejuvenate the economy. Now, this is another thing which I wanted to say, is that what is the financing of the fiscal deficit? As you can say, is that the government has been very clever in its financing of the fiscal deficit. It has reduced the component of the short-term borrowings in FY22, but we have a feeling that the short-term borrowings could be increased. So this will actually reduce the dependence of borrowings from the market, that yellow component, which is 60.9% to dated securities. So I think that is going to decline from the market, and that goes to decline from the market. That could actually spell well for the overall interest structure in the economy. So this is the important thing. Now, what in terms of the budget? The total government borrowing budget is also elevated in the current year, but it is almost at the same level, around US 252 billion. But the important point, and as I will show in the subsequent slides, is the Reserve Bank has been remarkably supportive of the government borrowing program. The last year, 243 US billion government program is going through, with the government borrowing at the rate which is the lowest in the 16 years. And the RBI has been doing all sorts of steps in the market. Sometimes it is cancelling the auctions, sometimes it is retaining some of the auctions as in green shoe options, sometimes, and it is giving a signal to the market that it will not allow the yield to go up at any cost. This is actually remarkable debt management on the part of the central bank, which is supporting the government of India's fiscal expansion. So this is the most important thing which I wanted to say. This I will not say. And the other important thing is that the extra budgetary resources of the public sector units are also going to decline significantly over the last 3 years. And the overall fiscal deficit, for example, if you look into the table, the last 2 rows, that shows the fiscal deficit of the center and the fiscal deficit of the extra budgetary resources of the center. These two used to diverge significantly from FY20 till FY21. But now this year, because of the off-balance sheet cleanup, this number is actually going to look remarkably similar. And this is the transparency which the market is actually cheering, because at the end of the day, the government has said that we are spending to reinvigorate the economy, and the market has no problem to that as long as growth comes back to the system. And there is clear evidence that growth is actually coming back into the system if you look into the leading indicators, as I showed you in the beginning of some of the slides. Now, India's sovereign debt, actually the Indian problem, there has been, and fiscal policy has been traditionally pro-cyclical in the Indian context, if you can look into the history of the last 70 years. So that is nothing new. But the important point is that the budget has now talked about fiscal policy being counter-cyclical, but we also need to understand that India's fiscal debt is sustainable, because there is always a significant difference between the nominal GDP growth rate and an interest growth rate. Last year was an exception, but I think this year, with the nominal GDP growth rate possibly at 11, I think at 16% or so, and an interest rate of around 6%, I think the gap will significantly widen. So we, in terms of public debt sustainability, we don't have any issue. I call it as you know, in the literature, we call it the Domer debt sustainability condition. But interest, and the other important thing is that the interest payment as a percentage of GDP has been declining steadily from 2006 to 7, thanks to the RBI's significant debt management. And this year it has gone up because the denominator has shrunk, the GDP. But again, with the RBI taking enough steps, I think this will remain under control. And as long as interest payment as a percentage of GDP remains under control, I think India's public debt will largely remain sustainable, even though debt to GDP ratio is likely to climb to around more than 86% in the coming year. But I don't take that as a constant. Now, what are the important steps in the budget? This is the budget for infrastructure. This is the budget for physical infrastructure and developing the health infrastructure. What is there in the budget? The total proposal capital expenditure in the budget is around 76.3 million. This is the estimated. There is a creation of a DFI. There is an asset monetization which will account for 6.4%. And this is the total US billion estimated infrastructure spending in FY22, which is around US 68 billion. So, and the DFI is expected to create a base of 68 billion over an equity base of 2.7 billion, implying leverage of 25 or 5 times per year. So there are significant opportunities over here in terms of the infrastructure spending. The health expenditure is going to increase by, and health and well-being are going to increase by a staggering 137%. Our expenditure should now be at 1.8% of GDP, which is now higher than most South Asian countries like Indonesia and others, and very close to countries like Malaysia. And hopefully in the next couple of years, this number could actually go up significantly. So this is the more important things about the budget, of giving a larger allocation on health and well-being of the common citizens. This is basically India's the health infrastructure. It has a number of medical colleges, PGS courses, total admission. And but the good thing is that there are states which have done a larger proportion of health expenditure in the recent years, like Delhi, northeastern states, then Sikkim, Jharkhand, Tamil Nadu. So many states are now increasing their expenditure on health in FY21 when compared to FY20. So that's a positive step, because at the end of the day, health builds up human capital, which is very important to generate returns over a period of time. Now, what are the other proposals in the budget? There are several other proposals in the budget. For example, there is a proposal for 2.15 billion support to MSME. There is a credit flow under the scheme of stand-up scheme of scheduled tribes, scheduled caste and women. There is also a proposal to incentivize setting more startups in the country. There is also a proposal which I have not written over here, is that in terms of the tax incentives, the government has now said that the appeals of tax will be reduced to 3 years. So that will make the tax structure even more, the tax infrastructure in India even more attractive for the income taxpayers. There is also an 1,504 initiative for making the digital payments in India. As you know, digital infrastructure in India has significantly declined, and the government now wants to bring the digital infrastructure to the rural areas. There are also other things on the agricultural sector, as I will show you some of the slides where some of the agricultural efforts the government has done. The agricultural credit target has now been enhanced to 230 billion. There is a significant development of this government initiative on rural infrastructure development fund. Micro irrigation fund has been doubled. So there has been more mandis is now integrated with INAMs. APMCs will be modernized. Fishing harbors will be set up. Seaweed park will be established in Tamil Nadu. So agriculture, the idea is that to replenish the agricultural infrastructure, so that to farm to fork, so that we can actually replenish the allied activities of the farmers. Then tax proposals, as I have said, senior citizens will now not have to file returns. So the compliance of this will come on the banks, will have to now develop the necessary infrastructure. And as all of us know, I think this is one of the reasons I think banks will develop the infrastructure. EPF interest income about 2.5 lakh will be taxable, but that is for the taxpayers which are in the higher tax bucket. The agriculture infrastructure development sales will generate 30,000 crore, which will develop the APMC infrastructure. Buyers of affordable houses, the tax relief will be extended from March 31, 21 to March 32, 2022. Now, this is the most important part, is the asset reconstruction company will be set up to clean up NPAs in the banking sector. And we were actually estimating today, I was estimating for the last 2 days. I think the most important thing is that this will lead to a better price discovery. This will lead to an aggregation of capital. And most importantly, given the fact that banks have actually provisioned 90% of these loans, so it will require significant amount of less capital. So basically, we are estimating that the capital requirement for these loans could be even at around 3,000, 4,000 crore. But with this recovery, you can generate, you can actually get back recovery, and you can also plow back capital. So here the numbers are actually humongous in terms of the benefit, because the banks have actually provided most of the funds for the stressed assets. There is a proposal for capitalization of the PSBs. Depositors will get immediate access under the deposit insurance scheme. And as I said, development financial institution will be set up with a lending portfolio of 70 billion in 3 years. Then the government has also proposed to increase the FDI limit in insurance sector. This is another important thing, the insurance penetration in the country, which is now at 3.8%. It will go up to the world average is 7.2%. So it will actually pull up. And we are expecting that around 2 to 3 billion investment could come in the FDI in this next 5 years in these sectors, and around close to 1 billion in the next 1-2 years, which could develop, and also it could develop deeper product expertise and better underwriting skills. So the insurance sector also stands to benefit significantly from this one. The NPA sector of the banking sector has been coming down. That will be the greatest positive surprise of this pandemic, that the banking sector will actually come out unscathed. As you can see over here, all banks is now providing a provision coverage ratio of around 85 to 90%. So there is this, so therefore this AMC structure will be set up with the minimum amount of capital. And if I just on a lighter note, minimum government, maximum results. So here it will be minimum capital requirement, but maximum results, maximum recovery, which we can get from this one, and maximum value addition. And the CASA ratio, as you can see, of the banks have increased significantly. The rate of interest are turning positive, and the gross NPA, the net NPA ratio of most of the banks are significantly on the lower side, indicating that we have nothing to provide for in the beginning. And this is the biggest surprise of this crisis. Indian banks and also globally banks, which a lot of commentators actually missed in the beginning, Indian banks and mostly global banks have walked into the crisis with adequate capital, adequate provision. So therefore, they have come out of this crisis relatively unscathed. And the Indian banks and the regulator also needs to be complemented, because they have developed a system of financial discipline within the banking system, which is now paying back in great deals in this year or so. So it's actually not a mean achievement. It's not it's a big achievement in terms of the Indian banking sector. This is the corporate earnings. The corporate earnings have actually been significantly larger. However, there's a downside to it. Small companies and even larger companies have cut costs significantly, and most of them has been employee costs. So there has been an element of job losses. There has been some element of salary rationalizations. But sectors like steel, cement, IT, pharma, all sectors are showing better growth numbers in Q3 FY21. The important message is that we are now listening that salaries are possibly getting restored in the month of April. But of course, there has been some amount of this distress in the labor market, which we need to admit, given the fact that most of the time this company is actually in lockdown mode. But they have recovered significantly strongly if you look into the results. The important point is that we also estimated that the likely slippage into the NPA will be very much insignificant. I remember one person was writing at the beginning of the pandemic that out of India's credit outstanding of 100 lakh crores, India's total NPA could be around 20 lakh crores. I don't want to use a stronger word, but I will laugh at those estimates which were made out at that point of time, because the Indian banking sector, as I'm saying again, that's a greatest finding of this pandemic, that the banking sector is coming out relatively unscathed. Of course, there are some pain points in the MSME, the agricultural sector, but they are much more manageable than what it was anticipated. And this is another important thing. You can look into the credit rating upgrades, metals, steel, cement, gems and jewelry, financials, all sectors is now witnessing and rating upgrades. Although the upgrade to downgrade ratio is still lower than 1, meaning there are more downgrades and upgrades, but actually the number of upgrades have gone up significantly into August and December than it was earlier happening. So this is the important point to note, that India's corporate sector also is looking positively upward, even in spite of the pandemic. And this is another one. If you look into the top 500 companies, the total addition to market capitalization has been US 756 billion in the last 23rd March to 2nd February 2021. This number has now crossed 800 billion, and the percentage of GDP is now 58%. So everybody has win. Financial services, IT, oil and gas, consumer goods, automobile, pharma, all sectors you look into the weighted contribution, all of the sectors has contributed to this rally. And the important point is that there is a debate that there is a linkage, that the financial sectors and the real economy, there is sometimes there is a disconnect. Of course, there could be a disconnect, but at the end of the day, please note that the markets are always gives you a discounted future value of the future stream of earnings. So the markets cannot lie for a period of, say, continuous period of 11 months. So my sense is that this shows that there are the potentials for the India's growth remains quite strong. Even if I assuming that if we just look into the market sentiment over the last 1 year or so, there has been a lot of initiatives for the NRIs in the budget. One initiative is the 1% one company incorporation. The government has also decided to eliminate double taxation on the NRIs on foreign retirement funds. The affordable housing bodes very well for the government, for the NRIs, because the extra deduction will be made available that will actually help them. And there was a report recently which says that the affordable housing accounts for more than 35% of the overall housing supply in the top 7 cities, which are of significant interest to the NRI investors. There was a report that NRI investors are actually investing significantly in the affordable housing segment. Now, this actually one slide which I want to show it to in a lighter vein. Why I am so much confident about the budget today? Because it's of a fiscal monetary coordination of the RBI and the government, which they've been doing for the last 11 months. Let me talk about a small economic theory over here. I'll not talk about in details. It's basically about it is called the game of chickens. Basically, there are 2 drivers who are driving on the highway, and both the drivers, say for example, car drivers, believe that they should not swerve, let the other person swerve. So if both of them decides to go head on, so there will be a fatal crash. So in this case, both of them may lose their lives. So I have indicated them as -10 and -10. But in the case that if one of them decides, okay, let me swap. So basically, in the economic parlance, I am saying he's chickening out. He swapped, the other doesn't swap. In this case also, the payoff, basically one is going head on, the other is swerving. In this case, the person who is swerving, he may the benefit will be much higher than in the case both of them actually does not swap. Both head on. And in the case both of them swap, the benefit will be the maximum. So the point which I'm trying to make over here is that the RBI actually has been acting like more of a chicken in the current situation. It has accommodated a significant government borrowing program in the last 1 year, and it intends to do so given what it is giving an instruction to the market. And if that is the case, and in my sense, the government has also been very accommodative and working with the RBI. So we are actually in an ideal situation, and both of them are swerving. but coordinating with each other. And this fiscal monetary coordination is playing is helping the Indian economy to recover in leaps and bounds as we had had in the last year, because the RBI has been able to bring back financial stability to the market. RBI has been able to address the fastest rate transmission during the pandemic. The rate spreads have lowered. The NBFC is now being able to borrow at the record low numbers, which was unheard of even 1 year back. So everywhere there has been an element of financial stability which has happened. Finally, I'll talk a little bit about some food for thought for the current agricultural bills, which is a lot of protest. I think these bills are very important bills. These bills gives an option to the farmers to sell outside the APMCs. I don't know why there is so much protest, but I will give you some numbers and some food for thought over here to explain that why these reforms are important at the end of the day. I think there is maybe some extent of some political motivation over here. Let me give you some numbers over here. For example, in this case of wheat, where Punjab is the maximum production of wheat, second production, Uttar Pradesh is the first production in terms of wheat. But look into the procurement. There is an asymmetric procurement structure currently in India. For example, states which are higher in production are actually lower in procurement, which should not have been the case. And this is why this is what the government is trying to do, trying to develop an infrastructure so that their farmers can sell outside the mandis. Currently, the FCI is located mostly in states like Punjab and Haryana, which are cereal granaries. And that was built up during the Green Revolution. But right now, as the time has come to develop the infrastructure in every Indian state, and the numbers over here, for example, rice, look into the rice. West Bengal is the topmost production in rice, but its rank in procurement is only 8th. Punjab is the third production of third, but its rank in procurement is always 1. Let me pick up another state over here. Uttar Pradesh is the second largest production of rice, but its procurement is a 7th. So we have to correct this lopsided procurement strategy. And in fact, the mandis which is registered at INAM are very less in states like Punjab. It is only 37, and all in Haryana it is a little higher at 81. But because these farmers get an assured return, so there is no need to link to an INAM. But look into the numbers in Gujarat, Maharashtra, Rajasthan, Uttar Pradesh, whereby a large number of mandis registered an INAM for a better price discovery. So this is the state of Indian farming. We need a price discovery very badly. This is some of the numbers. India has an average annual income households, agricultural households is around $1,500 US. Punjab is close to $4,000. So we can actually, it is 2.5 times higher than the national average. The other thing is that why, when both dairy farmers or those growing fruits and vegetables have freedom to sell their produce anywhere, why not other farmers? Because fruits and vegetables and this restriction is hampering their growth. Cereal output has grown by just 1.6% during FY1 and 19. Horticulture grew by 4.4%, dairy by 4.5%. Dairy accounts of 22.5% of India's farm output. There is no MSP for dairy. Horticulture accounts for 21.1 value percent of the farm output versus 16.4% of cereals. 60% of the farmers today have less than 1 hectares of land, and 86% have less than 2 hectares. So these reforms are important for the benefit of the small and marginal farmers. This is the value of output per hectares. Fruits and vegetable is 7,572 US, where pulses and cereals are at 633. So we need to diversify from cereal granary, and the APMC will stay, but at the end of the day, we need a better price discovery for the benefit of our farmer class of the 14.6 crore farmers in India. And this is another slide which I wanted to show. I'll not get the slide. There is also some, many times I have found that there is a discussion that the banks have actually become risk averse. This is not the case. If you look into the data, the bank credit to the infrastructure sector in the crisis years actually expanded in excess of 30 to 40%, and that was one of the reasons why some of these issues happened. But now I think there is no risk aversion on the part of the commercial banks to lend, and that's the most important thing. The other important thing, this is the performance linked initiative scheme the government of India has launched, and the total financial outlay is around US 20 billion. This is the financial outlay of the 10 sectors. As you can say, pharmaceutical, automobiles, electronics, advanced chemicals, food products, solar PV vehicles, white goods, specialty steel. Everybody has actually gotten the incentives, and that is actually going to help. Finally, some trade relations and opportunity of India and Gulf countries are important trading partners of India. Among the Gulf countries are major trading partners of Saudi Arabia and UAE. India runs a trade deficit with the Gulf, as you know, because of its crude oil imports. Bilateral trade between Gulf and India has also declined, but this is basically the Gulf countries' bilateral trade. If you look into it, till FY20, our exports was 40.5, and we actually run a deficit over there. The country-wise share, I can see that Saudi Arabia share is 22%, UAE is 59%, others is the share, and this was the country-wise share in imports in April to November 2020. These are some of the exports: mineral fuel and oil, gems and jewelry, electrical machinery, cereals, ships and boats, organic chemicals are some of our major exports to the Gulf countries. And our imports from the Gulf constitute some mineral fuels, pulse and precious metals and aircrafts. So this is basically gives an idea of where we can actually trade and scale up for trading opportunities. And also there's a significant investment from the Gulf countries in India. There is a CIA, the partner institution from India, for the India GCC Industrial Forum. India should actually consider itself as an attractive destination for the sovereign wealth fund, which is owned by the GSS states. And the infrastructure sector presents a significant lucrative opportunity for these funds. Energy security is a key pillar of our strategic partnership between India and GCC countries. And with focus of agri exports in India, and India already exporting cereals to these countries, it provides significant opportunity for global GCC countries to invest in agro-processing industries. And that is extremely important because we are trying to develop our agricultural fork to supply chain. Technology, mining, construction, defense provide opportunities for Indian companies. And this is basically the FDI inflows from India, which has come in. This is the data. So there is significant opportunity for the GCC markets to invest in India, maybe through a foreign sovereign wealth fund, which actually is completely tax incentivized. So I would like to end here. And as I end here, the point which I am trying to say is that this is a budget for change. This is a budget for growth. This is a budget for consolidation. This is a budget for spending, and this is a budget for revival. So I would like to end here, and I'll be glad to take some questions in the next couple of minutes. Thank you.
Thank you. Thank you, Dr. Ghosh, and thank you, Mr. Venkat as well. What I thought was that we could start with a few questions in terms of a dialogue, and or rather a panel session, and take it from there. I mean, first of all, I think Mr. Venkat Nageswar, you gave us the big picture and also highlighted, the high-level overview of SBI itself, which clearly is not just a bellwether stock, but I call it the juggernaut of Indian banking. When SBI moves and gains momentum, I think that's good for the Indian economy. And I think the current context of the budget focusing on infrastructure. So my first question is, how well are SBI and the banking and financial institutions gearing up for this large infrastructure push? I say this specifically with regard to the fact that many of the large developmental financial institutions of the past, like IDBI, IFCI, ICICI, which were project finance institutions, development finance institutions, became retail banks, retail commercial banks. So we need to redevelop, put together, the skill sets, the experience of project lending, especially the whole gamut of international project finance, as it were, supply credit, export credit, and everything that is to do with capital expenditure imports, infrastructure financing, and also making sure that there are takeout mechanisms. I'm conscious that SBI is a commercial bank, and ultimately you are lending depositors money largely. And so we need to rediscover and reinvest as banks in creating those skill sets, etc. So I'd like your comments, Mr. Venkat Nageswar, on this subject.
Yeah, thank you, sir. One of the important points that I would like to mention, I think Dr. Ghosh had skipped it. One of the important points is that the budget is proposed a developmental financial institution to be set up with a capital of 20,000 crores, which can leverage to the extent of 10 times, so that they'll be to the extent of 200,000 crores will be the level at which they can lend to the various long-term infrastructure projects. But having said that, let me also tell you that State Bank of India has developed capabilities of identifying and financing these projects, long-term projects. We have set up a project finance strategic business unit in SBI itself, that is way back in 2008-9, and right now we have people who have developed the specific skill sets to evaluate, and we also take the external people, the specialists are also on board, who, like in the steel specialist, or if you look at the power specialist, they are also taken from the external places who would evaluate the projects and fund it. But you're a Bangor, you're very right. One of the biggest challenges that we're going to have in case of the commercial banks is the asset liability mismatch, because the maximum a tenor or the maximum duration of my deposits or my resources is around 3.5 to 4 years, whereas the average duration of these assets are longer, and therefore there are takeout financing and other things. Our experiments have taken place, but we are poised enough to take care of certain projects at the moment, and at the same time, with the developmental financial institution coming up and the development of the bond market. If you look at, Mr. Suresh, the way in which the bond markets have developed recently, given the push by the government of India, given the push by the Reserve Bank of India, given the fact that they're trying to bring the liquidity, one of the biggest challenges in the bond market is that the lack of liquidity. So what they are trying to do is repoing those securities, providing liquidity, two-way codes, allowing outsiders to come into the market. So they have developed the bond markets, bringing the developmental financial institutions and commercial banks like State Bank of India, which have developed the necessary skill sets, all together would be in a better position to take whatever infrastructure funding that is happening.
I agree entirely, yeah. Moving to Dr. Ghosh, you mentioned about the budget's, huge outlays for capital expenditure infrastructure build-up. I called it in a recent comment to the local press here. I said this is, yet again a nation-building budget. We're literally rebuilding the nation in terms of infrastructure, and I think that's absolutely vitally important. It also, in a more of social and moral sense, creating assets which can then generate surpluses to pay back the debt that might be taken, or the deficit financing that is undertaken to incur those expenditure. So I think it's a tremendous budget in that respect. It's not pledging the future of the future generations to incur debt, which is always a worrying phenomenon. But the overriding questions in many minds is there's been a significant job attrition during the pandemic. Even otherwise, India needs to create jobs, over 10 million jobs a year to absorb the young demographics and the young population that is coming on stream. What are your thoughts in that respect?
No, I think regarding the jobs, I think we actually have done a lot of study on the jobs earlier. In 2018, we had published a report on this payroll report, after which the government actually accepted the recommendations of the report and started publishing the data. The problem in the Indian context job is that it is basically the unemployability of the jobs and people not getting proper remuneration of the jobs which they're doing. So that I think, and I can actually see a lot of skilled person actually getting salaries which are not commensurate with what they are getting, and also there is a mismatch of skills in different sectors. So that is so basically underemployment is typically the problem in the Indian context. The other important thing is that of course there has been a disruption in the pandemic. And if I look into the labor market, as I have shown in the find, the small firms are actually cut their employee cost much more than the large firms. There has been, of course, job losses. There has been, of course, rationalization of the salary, which is now being slowly restored, as if we understand. So there has been some labor market disruption, and this is basically some of the scars which has come with the pandemic, which will take time to go away. But the important point to note over here is that the important point which we need to note, the government actually has has given its focus on most of the labor intensive sectors in the current budget. For example, construction is one of them. If you can look into these construction, roads, everywhere there is the employability potential is higher. Housing, the government has given a larger focus. So basically the government is cognizant of the fact. So therefore, by that logic, I think even though the employment is a problem which has to be acknowledged, but there is also the good thing is that there is a lot of incentives which has been given to sectors that create jobs in the budget, and hopefully, we'll be moving in that direction, because this has been a long-standing issue. But in my sense, I always believe that underemployment is a more major issue than an unemployment in the Indian context.
Another question for both the panelists. I think the significant investment opportunities that the budgetary capital capex allocation will mean that India's FDI will have to move up, both in terms of debt FDI, long-term debt, that is bonds and investment in both corporate and sovereign debt paper in India, so that the debt inflows are currently controlled by RBI, so that may have to be relaxed to be able to fund this huge infrastructure push to reach the $5 trillion economy that we are targeting. So in that context, what are SBI's plans to, you have one of the largest networks of overseas offices, and by default, SBI will be the first port of call when global investors, especially institutional investors, want to verify and check and assist, etc. So how is SBI gearing up for this large investment flow? Perhaps Mr. Venkat can start, and then Dr. Ghosh can chip in.
Yeah, this is a very valid point, sir. As you have rightly mentioned, today, one of the important things that the country requires is the capital, and the capital is required both in the form of equity and in the form of debt. And we are, this is one country where the returns are going to be positive. Returns are going to be quite, even after taking one of the points which we are looking at the panel discussion with the chart, where they're talking about rupee appreciation or rupee depreciation, or where the rupee is going to be there. But given the fact that there's going to be a good amount of flows, the return that the people are going to get, not only on the carry front, but also on account of the appreciation of the rupee, people will be definitely benefited. So there is, and this is going to be a positive return, and therefore we are expecting good amount of FI and FDI flows coming into Indian markets. And State Bank of India is one of the important points that you had said. We are available in 32 countries, right from Australia to the California. We are present across in all the centers. And we are in constant touch with all the FIs and FDIs through various meetings. And we are set up our own merchant banking units that's in London, in Singapore, and we are planning to have it in Dubai as well. And in addition to that, we are continuously interacting with all these investors, and we have providing end-to-end solutions. When I say end-to-end solutions means right from the time they think of investing into India to the time they exit, providing custodial services, providing broker services. Through all our subsidiaries, we are in a position to provide end-to-end solution to our customers, including the legal. We are having a legal counsel who will be advising them, tax consultants. We are providing all these things so that it will be easy for the people who are planning to invest in India with our capital markets subsidiary, also guiding them where to invest, mergers and acquisitions. So SBI is a financial conglomerate. With all these subsidiaries together, we are well poised to support the FDIs and FIs who are looking forward to come and invest in India. And one thing that is there is good thing about it, as I said in the beginning, there is going to be a positive return, not just on the interest, but also on the account of the exchange rate appreciation. So Soumya, I can add something more on this.
Yes, I think the external, apart from the SBI, I think the external sector of India looks extremely competitive as of now. And given the record amount of forex flows, the Indian rupee is likely to be in an appreciative mode or a range bound. The central bank actually has built up significant amount of foreign exchange reserves, as I have said in the course of the discussion. 120 billion foreign exchange reserves. I think India is now the 4th largest country in terms of the foreign exchange reserves, if I am not mistaken. So given all these facts, I think an SBI's presence in international countries and international, and it is brand value, it is 20% of India's GDP, SBI. And it's basically, given all these facts and given the facts that there are several initiatives which has been laid out in the budget. There is also, for example, this ARC and MMC structure which is laid out in the budget, that could also be a game changer in terms of developing a market for stressed assets, or where SBI can actually play a significant role in bringing in the foreign investors. So I think on all counts, with an external competitive external sector, with the economy moving up, and with a large presence across countries, across markets, across geographies, across product segment, I think the SBI is very much well positioned to take advantage of this one, of this upturn in the economy. And also the fact that the banking book is now adequately capitalized, as I said, and adequately provisioned. So if I look into all these factors, I think all factors now look favorable for a situation whereby SBI actually can expand itself even further in line with the business cycle, in line with the vagaries of the business cycle.
Thank you. I think I'll raise one final question, which is an interesting one. This region, as you know, there are several entrepreneurs who have built up businesses, and many of them would like to participate in the SME sector, in business sectors, with two objectives. One objective being, since they are very familiar and experienced in this region and this part of the world, they would like to bring good Indian companies, well-performing Indian companies, to this region and support them in terms of joint ventures, in terms of growing globally, so that you create Indian MNCs or Indian multinationals. 2 or 3 sectors, even the regional governments, the GCC governments, the UAE government, the Saudi government have identified are food security. And this goes back to Dr. Ghosh, your comments about agriculture being the next industry that will require significant growth momentum. And the second one is pharma security. You described India as the pharmacy of the world. Every country wants to ensure that there are no supply chain logistics issues, there are no supply chain risks, that there are no vulnerabilities on that score. So I'd like both your comments on this opportunity and how would banks like SBI gear itself up for this. In fact, we had the Minister, Nitin Gadkari ji, with us a few months back, and we actually agreed with him that we will create an SME-focused investment fund that would go into India, invest in good companies in India and try and bring them in, try and globalize them in terms of quality, standards, scale, and the like. So I'd like your comments, both of you. Perhaps, Venkat ji, you can start.
So one of the important points that I would like to mention here is you talked about the creation of a fund for supporting this SME sector. Let me bring to your kind notice that we have SBI along with SGRF, the Sovereign Wealth Fund of Oman, had come out with Oman-India Joint Venture Fund, which was a $1 billion fund. Initially started off with $100 million. And after the fund one was successfully invested in small and medium enterprises, the fund has been expanded into the second fund has gone up to $300 million. And we have also successfully invested this particular money into SME sector. So we already created this particular infrastructure and the capabilities that are there for supporting the SME sector in India. A UAE fund, which you're talking about, Mr. Kumar, would be of a great help. And State Bank of India, we already have a model. The return with numbers are very good. I mean, we can make a separate presentation on that. So we already set a model in the beginning, and we can make a presentation to you as well. If you're coming for supporting the SME sector in the form of creating a fund, SBI will be in a position to help you in doing that. And Soumya, we can take the question on the food security.
No, I think one point I'd like to add, I think SBI has a very vibrant investment desk also in some of the, for example, India also, which takes care of the interest of the companies. And I think our office in Dubai is actually significantly equipped to take into interest any expression of interest by any of the companies. So that's the best way to approach. So I think, and because this will go into the right place and the right people. The first thing regarding the food security, yes, I think the agricultural sector needs investment. The agricultural sector needs price discovery. Exports is one of them. You will be very glad to know that even in this pandemic, when our exports have declined, but it is for the first time that agri exports have actually increased in the last 4 to 5 months, and that has been doing very well. In fact, after the farm law were passed, the commodities which has come outside the mandis have actually increased. So my sense is that agricultural exports is something which we need to push significantly. There are significant potential for agri exports, and I think the government has already passed the laws like these essential commodities, which basically is a very positive for development of the storage and housing. And these I think will go a long way in terms of the farmers' realization of better prices, because at the end of the day, that is the biggest problem in the Indian context. And also, for another example, I want to give, if I give the example of Malaysia, I think there could be the government can always do some changes. For example, the government has emphasized on the contract farming. The example of several other countries like Malaysia shows that if the government is an active push in that sector, that works well. So maybe there could be some amount of tweaks over there in the agreements. I am not sure, but my sense is that this is a bill in the right direction, and hopefully, if this is taken through, this could actually change a large number of things with agribusiness is conducted within the country. And this will be very good for the small and marginal farmers who are actually 80% of our overall farmers in India.
Thank you. Thank you. I will now ask Mr. Veeraraghavan to pick it up from here and maybe add a few more questions to the panelists. Mr. Veeraraghavan.
Thank you very much, sir. We have a few questions from our audience. They have written to us. The first question to Dr. Ghosh. Do you think the huge government borrowing program and the fiscal deficit, will they have a bearing on India's credit rating?
I think that it should not, because the large fiscal deficit is more a manifestation of an increased capital expenditure and to bring back growth into one. Because at the end of the debt to GDP ratio is a function of both numerator and denominator, and the GDP decline, if that is arrested, and if that brings back growth, and as I've shown you, I think that will be taken positively by the rating companies. Today only, yesterday, Fitch has released a report saying that they are positive, or they are positive on the budget. So that actually, even though the fiscal deficit had gone up, but they are positive on the budget because that is growth oriented. So I am not so much concerned about the rating at this point of time. And I think and I can tell you in May, if you remember me in May, in the May 2021, you will see that India will have a fiscal deficit number which is lower than 9.5%. So take it from me that in May, when the final numbers are come, it could be a positive surprise. So my sense is that let us not concentrate on deficit at this point of time, because as long as it is more capital expenditure, augmenting capital expenditure, that will all, and which is basically builds up assets, that is also neutral for inflation. So as of now, I am not borrowed, and the RBI, as I've said, with the game of chickens, the RBI has been significantly cooperative with the government in terms of accommodating the debt management, and which actually today also, do you know, today we had a record amount of borrowing, and today the RBI, I was just going through a WhatsApp message right now, the RBI has been able to hold the yield in the GSEC market at one of the lowest levels, which they have been doing now religiously and assiduously for the last several months. So I think to borrow a word from Fed President Ben Bernanke, 2003 famous policy of monetary policy having a constant discussion, this RBI has actually unleashed the monetary policy on a discretionary basis, and that has worked wonders in accommodation with an activist fiscal policy. So I am not so much bothered about rating at this point of time.
Another question is, will there be enough private sector participation in a bad bank?
Yes, let me give you an example. I think bad bank, if I just put in some numbers over here, I think as of now, the total provision coverage ratio of the banking system is 85 to 90%. So basically, if say X amount of that amount has to be transferred to the bad bank, only 15% or 10% of that has to provision for. That means the capital requirement for these provisions, we estimated that it could be significantly minimal at 3,000, 4,000 crore, of which you will be able to cover and say an bad asset size of around 3 lakh crores. So with 3,000 crores, you will be able to cover capital, the requirement, you will be able to cover an asset requirement of 3 lakh crores because you have provided for 90%. And if that is the case, I think the upside to this ARC AMC could be a significant game changer. We can have a separate discussion on this when I can discuss in the maths. But my sense is that it is a very good initiative on the part of the government, because today we want to develop a market for stressed assets of buyers and sellers, which may not have developed to that extent which we would have liked to.
One question for Venkat, sir. Sir, do you think the LIC IPO is going to be a game changer in the Indian market?
Not just LIC, Veera, we are talking about a huge disinvestment program which the government is planned for the current financial year. In fact, I was interacting with one of the companies today morning, which is also within the disinvestment program. And what we observed is there is a huge interest among the external overseas investors to invest in India, particularly because this is a very good value buying. And I absolutely have no doubt in my mind for the success of this disinvestment program. But the government is planning very systematically. They're planning, they're looking at the right timing, they're looking at the proper marketing, they're looking at going out to all the investors, explaining to them the inherent strengths that are there, and then leaving no stone unturned to see to it that this program is going to be more successful. And given the current markets, it'll be very, very easy for them to roll it over.
So one more question I will direct to you, as you have been Deputy Managing Director for the global markets also. What would be your suggestion to broaden and deepen the bond market?
One important point, you and I know, all of us know that we are debating this for the last, maybe from 95 onwards or 94 onwards, we're debating about this. One of the important points for deepening of any bond market is the availability of liquidity. Liquidity is something that where you need to have a two-way course. We need to have should be in a position to sell or at least generate liquidity by repoing those securities. Fortunately now, and earlier only the markets were restricted to AAA and AA rated bonds. But now what has happened is, with the way in which Reserve Bank of India has come forward, and then they're trying to do the TLTROs, trying to provide repoing of the securities, making the corporates go into the bond market it is made mandatory for them to access to the bond markets. And given the fact that one of the important points Mr. Suresh has also talked about is FPI investments in the bond market, also they are increasing the amount that can be done. All these factors, and of course the CDS is taking its own time because there are certain restrictions which have been put in for the players, for the speculators. I'm not talking about manipulators, I'm talking about speculators, for them to come into this market. So once once we ease these norms, the bond markets are definitely going to develop. And that is very crucial for the big program that we have. And the market is moving in that direction. That's what Soumya was also talking about, the way he was talking about the game of chicken, where the Reserve Bank of India and the government of India are moving together in order to develop this.
Thank you, sir. Dr. Ghosh, one final question to you. Has the effect of the pandemic played out, or do you see more pain?
I think as of now, my sense is that if I am correct, India may have developed an herd immunity already. As I have mentioned during the course, we have not been witnessed in a second wave, we have not witnessed in a third wave, and with the vaccination starting, and even though there has been some number of cases, but I think we have gotten significant handle on the number of cases, and this actually reminds us of also if you look into the data of the Indian COVID cases, the total number of cases in the top 15 districts which was declining significantly until August, September, now has gone up in the last 4 months, but the other districts is declining. But all this in 15 districts also, the COVID cases fatality is also declining significantly. So that means that maybe the cases are now restricted to a particular area where there has been more amount of, I think we have developed a herd immunity. And my strong sense, and there is also a report today in the Indian media saying that maybe eating of proteins could have developed such herd immunity. So without getting into that debate, my sense is that hopefully we have been able to turn the tide against COVID. And if more vaccinations come into the market, which the government is indicating, I think it will open, and if it comes into the open market, it will actually hasten up the process of vaccination, which is good for the Indian economy. So as of now, I am pretty confident that possibly we have seen the worst of the past.
Thank you, Dr. Ghosh. Thank you, Venkat, sir. I will now request Chief General Manager of State Bank of India International Banking Group, Mr. Satyanarayana to propose the vote of thanks. Thank you.
Chairman IBPC, Mr. Sinha, Secretary General, DMD Sir Venkat Nageswar, Dr. Soumya Ghosh, my GCA and Vera. Thank you very much for your participation. Today's deliberation presentation budget has been quite interesting. The questions that were raised by Suresh Kumar, the queries, the incisive queries that he has posed, and the responses gave us lots of insights to the audience on how the economy is shaping up, how the budget is shaping up, and what are the benefits that one could derive out of it. And it is a very good budget, as illustrated by Dr. Venkat Nageswar and Soumya Ghosh, the scenarios that investors have. I think this budget delivered the purpose for which we have been trying to hold for a long time. And the participation is tremendous. And I thank IBPC for the wonderful coordination, and the way they've organized seminars quite tremendous, I should say. We have been holding seminars for almost 3-4 days. Tomorrow I have one more seminar. But of all, this is the best seminar we had. And the way the organization of the organizing seminar is fantastic. Thank you very much. Stay safe, stay healthy. Good night.
So one small thing, there were a few questions which we couldn't take because of paucity of time, but we will take it upon ourselves that we will get the replies for them from the panelists and pass it on to them.
Yeah.
Thank you. Good
Thank
night.
you, Mr. Veeragan.
Thank you, everyone.
Thank you.
Thank you.
Thank
Thank
you.
you.
Thank you.
Thanks a
Thank
lot.
you.